Welcome to CA Shiksha Exploring New Heights of Learning. This is Gaurav Sangtani. Today we'll go through Lecture 2 Accounting Equation. Let's see what are the learning objectives of this lecture. Today in this lecture we will learn what is accounting equation and accounting through accounting equation. First, let's revise what is accounting. We have seen in previous lecture, accounting is recording of flow of money. So, to understand accounting, we need to understand what is flow of money. The flow of money implies in business there is coming in of money and going out of money. In any business, coming in of money is called sources of money and going out of money is called applications of money. In any business, sources of money will always be equal to applications of money. And this is called accounting equation. Accounting equation says sources of money is equal to applications of money. What are sources of money? Sources of money are from where money comes in the business. It can be through owner of the business, that is capital. Money can come in the business from borrowers from the outside, that is liabilities. Earning of money from operations, that is revenue. These are the sources of money in the business: capital, liabilities and revenue. Applications of money are from where the money is used in business. It can be applied in purchasing long-term, short-term resources for the business, that is assets. Meeting day-to-day obligations of the business, that is expenses. So money can be applied in assets or expenses. So let's revise. Sources of money are capital, liabilities and revenue. Applications of money are assets and expenses. If I expand the accounting equation with these terms, sources of money equal to applications of money, now I can replace it with capital plus liabilities plus revenue is equal to assets plus expenses. So accounting equation is capital plus liabilities plus revenue equal to assets plus expenses. In this equation, expenses and revenue are from day-to-day operations of the business. And difference of revenue and expenses is either profit or loss, and it goes to capital account because it is for the risk owner has taken. So I can simplify the accounting equation further. And we can make it accounting equation as capital plus liabilities plus revenue equal to assets plus expenses. We have just seen revenues and expenses will ultimately go to capital, so we can write it as capital plus liabilities equal to assets or capital equal to assets minus liabilities. Accounting through accounting equation. For this purpose, we need to take expanded form of accounting equation, that is capital plus liabilities plus revenue equal to assets plus expenses. Sources of funds have a natural credit balance. That means sources of funds will have a credit balance. Capital will have a credit balance, liabilities will have a credit balance, revenue will have a credit balance. These are their natural balances. And applications of fund will always have debit balance. Assets will have debit balance, expenses will have debit balance. These are natural balances. It can be otherwise also, but these are the natural balances. We have seen the natural balances of sources of money is credit. So, if there is any increase in source of money, it will be credited. That's why increase in capital is credit, increase in liability is credit, increase in revenue is credit. And we have seen that natural balance of applications of money are debit. So any increase in assets will be debit, any increase in expenses will be debit. And opposite will be the case in decrease. Any decrease in capital will be debit, any decrease in liabilities will be debit, any decrease in revenue will be debit. And any decrease in assets will be credit, any decrease in expenses will be credit. That is end of lecture 2 accounting equation. See Shiksha exploring new heights of learning.